Hi value investors, welcome to my channel. Today is more important than ever to develop our investment philosophy, and that is because we are facing a difficult scenario in which there are so much uncertainties ahead of us. And this, for example, we have the conflict between Ukraine and Russia, we have a surging oil prices, we have the surge of the inflation rates, and the more aggressive action required by the Federal Reserve. So there are lots of things and lots of uncertainties that could slow down many economies and could slow down, of course, the growth prospects of many companies. That's why it is important to develop an investment philosophy right now, because we are getting into a scenario which is completely different from the last 8 years, in which most people were investing in so much speculative stocks and they were earning so much money, but now things are completely different, and that's why it is important to develop this kind of philosophy. Now, of course, the purpose of this video and the purpose of this channel is to promote more the value investing strategy, the value investing philosophy. And that's why I will present to you the different strategies within the value investing philosophy. You will discover that there is just one strategy. There are several strategies within the value investing philosophy, and you could discover which of them could fit better with your personality, which of them could fit better with your perception about the stocks. And that's why I consider this video could be valuable for you. Then I will make a comparison with other kind of investment philosophies totally outside the value investing field. Okay, and then in the third part of this video, I will just make a comparison between two strategies. One of the most well-known strategies, which is the buy and hold strategy within the value investing philosophy, and we will compare that with the trading strategy. I wanted to see which of them could give us a better chance, a better return over the long term. So I will start right now. So the first strategy that I will talk about is the Ben Graham's strategy. You know that Benjamin Graham is the father of the value investing philosophy, and he has written, of course, the books of the security analysis and the intelligent investor. So you need to remember that when Benjamin Graham started with this philosophy, it was in the 1930s, 1940s, after the crash of 1929, and we need to remember that in those years there was a bearish sentiment respect to the stock markets. Nobody wanted to know anything about the stocks in general, and Benjamin Graham was one of the first investors who truly want to put certain rationality into the investment decisions. So here in those years, the only financial statements available were really the balance sheet and the income statement. You need to remember that the Financial Accounting Board required that the companies release the cash flow statements in 1987. So there wasn't any sort of cash flow statements in the years of Benjamin Graham. So I could notice that he was more focused on the balance sheet rather than the income statement. And probably it is because he was more interested in companies that were facing temporary setbacks, that were facing problems with the growth prospects, or problems management decisions, and that required, of course, an important turnaround. And that's why one of the most important things that make these companies that were undervalued with respect to different metrics. He established the calculation of the intrinsic value through the liquidation value per share, to the book value per share, the net current assets minus total debt per share. This is the most commonly used metric by Ben Graham, and the available assets per share. If you notice, all these metrics could be calculated directly from the balance sheet here. And in the case of the income statement, well, Benjamin Graham, of course, wanted to look for the income statement, but he was not so much interested in companies that were growing so much in terms of revenues, in terms of net profits, because of course these companies were trading at higher multiples, and he was not so much interested in those kind of companies. He requires that his portfolio needed to be really well diversified in order to compensate, in order to benefit from diversification, and knowing that, of course, that he was not buying quality here. He was not so much interested in buying companies with moat, with competitive advantages, and so on. For example, if he established this metric, the net current assets minus the total debt per share, if he found a stock that was trading well below this metric, it means that he was buying a part of the net current assets and he was getting for free the rest of the assets. That's how he perceived the investments. Benjamin Graham really held something like 20, 30, 40, or even 50 different stocks in order to compensate all the potential risk. And another important characteristic of its management of his fund in the Graham and Newman was the fact that he considered that the stocks could be in his portfolio at most for 3 years. If the market didn't recognize the intrinsic value of some of those stocks, he just divested his entire positions in those stocks, and he just wanted to look for other opportunities in the stock markets. And nowadays, it is way more difficult to find this kind of situations, these kind of opportunities. But we need to remember that in those years, in the years 1930s, 1940s, 1950s, it was rather easier to find these kind of opportunities of undervaluation with respect to the net current asset, respect to the book value, and so on. Nowadays, there are some funds for companies that are trading with a lower price over book value, lower price over free cash flow, and lower price over earnings per share, in order to try to imitate what the old strategy of Benjamin Graham. Of course, they are not the same because, as you may know, Benjamin Graham never used the free cash flow in the early years of his career, and he was not so much committed to use the earnings per share as part of the calculation of the intrinsic value. He really wanted to look for companies to undervaluation respect to the net current assets minus total debt and so on, most directly from the balance sheet. Okay, but there are other group of investors who are truly committed with the strategy of the Ben Graham in those early years. This is the case, for example, of Jerome Boss from the NN Investment Partners. Look at how he thinks about the undervaluation, or about the strategy of Ben Graham. He says, deep value means I always start off with the balance sheet. That is the only thing that interests me. Lots of people try to argue that a stock is deep value when it has a low P over E or it has high yield. That I don't think is really value investing. That is something different. I really always start off with the balance sheet, and if that shows me it's cheap, then I'm immediately interested. I've always worked on that basis. I look very much at companies that hit new lows on a 52-week basis, sectors that look very badly, because that is obviously where you'll find them. It is generally where there's bad news, where there has been a regulatory change. That is where you find them. I have at stocks for 5 years, I have at stocks for 3 months. As long as the balance sheet doesn't deteriorate, where my margin of safety continues to exist, I'll stick with them. Obviously, I hope that management is working on shareholders' behalf in rectifying the position, but I have patience for them. So look at this, how Jerome Boss think about this strategy, and he's thinking like in the way of Ben Graham, because, well, Benjamin Graham, in order to compensate for the risk of not buying quality and buying companies that are facing problems and troubles in his financial statements, he wanted to, of course, to find potential catalyzer that could boost the future price of those stocks. In order to do that, he focused, of course, in the growth prospects of the company, in the tailwinds of the industry in which the company was operating, and of course in the capability of the management to make a successful turnaround. So that's an important characteristics in order to compensate for the risk of not buying quality, of buying cyclical companies, of buying companies with financial troubles, and so on. That's why, of course, that explains why these companies are undervalued. But of course, we need to find potential catalyzers that could boost their respective prices, and the market will end up recognize the fair value of those companies. A couple of fund managers that I found is the Mark Garrigaside and Luis Torres from Spain. Here they are managing the Japan Deep Value Fund, using, of course, the strategy of Benjamin Graham, just focus on one country here. So if you want to explore more about this strategy, you can read the security analysis from Ben Graham, or even the Intelligent Investor, the Deep Value Investing second edition of Finding Bargain Shares with Big Potential from Jerome Boss, and the Deep Value from Tobias Carlisle here. In my view, in my humble view, I wouldn't apply this kind of a strategy. I don't feel comfortable to explore so many companies, because you will need to explore many companies in order to invest in more than 20, 30, or even 40, or even 50 different stocks in your portfolio, in order to be well covered by the risk associated to not buying quality. There are other alternatives in order to take advantage of the market, to take advantage of this strategy. For example, to find out what are the fund managers who are using the Benjamin Graham's strategy in order to see if it's possible to put some of our money in these professionals who truly have the required set of skills that are necessary to be successful in this strategy here. So the second strategy is the high quality companies strategy, which means that you need to find high quality companies with strong moats, with strong competitive advantages, but you need to pay an adequate price. And in order to do that, you need to calculate the intrinsic value of these companies and to find out if the current stock market price is really undervalued with respect to the intrinsic value that you are calculating under this strategy. So here, the important thing to understand is that to buy at an adequate price. This is probably the hardest part, because most likely these kind of companies are trading at a higher multiples most of the time. So we need to have so much patience in order to wait for the right time to get into these companies. Probably this is the difference between super investors like Warren Buffett and Charlie Munger, and of course the common retailer investor who just buy high quality companies but at any price. And you know that whenever you are paying a higher price for any company, it doesn't matter if the company is a high quality one. The higher the price you pay, the lower your long-term returns will be. So here, what you need to do is to buy and hold. I mean, buy at an adequate price and hold for several years. This is a completely different strategy with respect to the Ben Graham's strategy that I explained before. Given the power that these companies have to set higher prices, and of course the demand for the goods and services by the customers will not be reduced in a significant way. So in that way, these kind of companies are able to generate more free cash flow over the years, more net profits over the years, and in that way these companies will have more undistributed profits or free cash flow to reinvest into the business and earn a higher return of equity and earn a higher return of invested capital here. Given the fact that you are acquiring at an adequate price these kind of high quality companies, you will need to be more concentrated in your portfolio. You don't need, of course, to be well diversified because you are buying quality in these kind of companies. So this is one of the main difference respect to the Ben Graham's approach, in which he truly needed to be really well diversified because he was not buying quality. But in this case, in this high quality companies strategy, you need really to be concentrated in order to take advantage of the compounding effect of the companies in which you are investing. You will need to understand how Warren Buffett has invested in these kind of companies over the years. Look at this. In the case of, for example, of American Express, he has invested in American Express when the company was facing a temporary setback. There was an oil scandal. You can search, of course, in Google in order to find out more about the details. But in order to make a brief comment, this oil scandal was affecting the reputation of the company, and of course that caused that many shareholders, many investors were selling off their American Express shares into the market. That created an opportunity for Warren Buffett to buy this amazing company at a discount. And the reason was that Warren Buffett discovered that current users of the credit card of American Express were using as usual. It didn't matter if there was a threat to their reputation in the short term against the company. He has taken advantage of the market, buying at a discount this amazing company, and he has kept the company for several years. This company represents something like 7 or 8% of the total Berkshire stock portfolio, and he has, of course, enjoyed a capital appreciation of more than 1,000% until nowadays. The same thing could be said respect to the Washington Post at the beginning of the 1970s, when Warren Buffett invested in that company. I mean, this is a newspaper company, and Buffett invested in this company when there was a scandal, the scandal of Watergate. So it was supposed that the company, this newspaper company, would release information to the public with respect to the Watergate scandal. And of course, most people, most shareholders, and most investors thought that this problem could give the incentives to the government to close the company. So that, of course, caused a massive sell-off of the company, and that's how Warren Buffett has taken advantage of the market again. He has bought this amazing company at a discount. The same thing could be said with respect to Apple, which is his main his main position within the Berkshire's stock portfolio, representing more than 44% of the total portfolio. That's a huge participation of a company, and he is really truly concentrated in just 3 or 4 companies. So Apple is the most important company within the Berkshire stock portfolio. And you should remember that he has bought this company in the years 2015 and the years 2016, when the company was facing a bearish sentiment respect to the growth prospects of the company, and that is because the competition was advancing, offering products were comparable in technology and in innovation, and of course there was so much reliance on the iPhone sales, and most analysts were complaining that the company was not launching new disruptive products as usual. So there were lots of challenges, and apparently most of these analysts didn't understand which were the real competitive advantages of this company, and Buffett understood that the competitive advantages and the moat was most associated to the brand of the company. So that's why he has taken advantage of the market again, buying this amazing company at a discount, buying at a price of $25 per share, $30 per share, adjusted by the splits, and now the company is trading at $160 per share approximately. So this is just examples how Warren Buffett has waited for holding these amazing companies at a discount, and that's why we need to be really patient using this strategy. The same thing could be said with respect to Charlie Munger, who is investing so much in Alibaba, a Chinese company, a high-quality Chinese company, which is critical for the Chinese economy and is critical for the government of China. He knows pretty well the country. He has studied so much the country. He has studied so much the company. He understands what is the culture of the company that Jack Ma has found in the year 1999. So he established that the growth prospects of this company are positive, despite the fact that there is so much bearish sentiment against this company. Buying, and when the companies are facing these kind of temporary setbacks or negative sentiments, because these are the times in which the price is really discounted. So look at this, how the calculation of the intrinsic value in these companies are completely different in the case of Ben Graham's strategy here. You are more concerned about the cash flow that these companies are generating. You cannot use, of course, the methodologies or the metrics of Ben Graham, because you are looking for other kind of companies. Well, if you want to explore more about this approach, more about this strategy, there are some books that are recommended. For example, the Warren Buffett's Way from Robert Hangstrom, and the Dando Investor from Monish Pabrai here are really important books that could give you a better picture about this strategy. Well, the third strategy is the special situations, and here you will find that there are different special situations, and all of them are associated with the value investing strategy, the value investing philosophy, because in all of them it implies that you need to find undervalued stocks under particular events. Okay, now this is a rather more complex strategy, because it implies that you need to know what are those events and what are the chances to be a successful investor in these kind of situations. So the first particular situation is the spin-offs. The spin-offs is when a parent company decides to release one of its subsidiaries into the stock markets in order to, of course, to raise some capital, or to give the incentives to the management of the new spin-off to be more shareholder oriented and create more value for this spin-off. Of course, this will give the opportunity to the market to unlock value into this new spin-off, because before the spin-off, this company, this subsidiary, was hidden within the parent company, so it was not possible to have so much information about this company. There could be different motivations why a parent company could release this kind of a spin-off. One of them could be by regulation, or it is possible that the parent company could be more attractive for a potential buyer because there is an underperformance subsidiary, and then the parent company decides to release this underperforming subsidiary into the stock markets. Another important point, it is possible that the parent company do not want to pay more taxes if the the parent company decides to sell the entire subsidiary in a private way to another company, the parent company will need to pay taxes here. So in order to avoid all those taxes, it is possible for the parent company to release the subsidiary into the stock market in a partial way or fully, in order to avoid all these taxes and of course at the same time raise some capital here. So there could be several motivations to release this kind of spin-off, but the most important thing is to know how an investor can take advantage of these kind of situations. It is when we are, for example, when a parent company, when the shares of the parent company are owned by institutional investors, the parent company decides to release this subsidiary into a spin-off into the stock markets. These institutional investors will receive the shares of this spin-off, and if the spin-off or the subsidiary has a market capitalization of less than 10% of the whole parent company, so the institutional investors are not allowed to own these kind of shares, because, well, by regulation they cannot hold these small size companies with so less liquidity in its outstanding shares. So that means that there could be a massive sell-off by the institutional investors selling all these shares of the spin-offs, and that's how an opportunity is created by those investors specialized in these kind of situations. So here it is important to understand that we need to be really selective in this kind of spin-offs. Not all the spin-offs are profitable. We need to find under these kind of scenarios that the spin-off has really growth prospects or has certain tailwinds into its own industry. We need to focus on the compensation package of the management in order to see if the management is enough incentivized to create more value for the new shareholders of this spin-off. And of course, because when we are acquiring at a discount these kind of shares, we are expecting that our shares will have a capital appreciation in the next year or in the next second year. But in this kind of situation, we cannot apply the buy and hold situation, because in most of the time this kind of spin-offs, we are not buying quality. We are just buying a company that could be undervalued under this particular situation. Well, in the case of the merger securities, it means that there is a buyer who wants to acquire a seller, but unfortunately for the buyer do not have enough cash to complete the transaction. So in order to complete the transaction, the buyer will need to issue warrants, will need to issue rights, will need to issue a particular kind of bonds in order to complete the transaction. Probably it is because the buyer do not have access to more loans from the banks or any other credit lines. So that's why the company needs to issue these particular securities in order to complete the transaction. You need to be, of course, pretty selective under these situations, because of course you are expecting a sell-off, and that is because the shareholders of the seller will receive these kind of securities, and then you are expecting a massive sell-off of these securities because the shareholders of the seller probably do not understand most of these securities and they are not interested in holding them. So if you are specialized in this kind of situation, you will buy these kind of securities at a discount. But of course you need to make sure that the synergy between these two companies, once the transaction is announced or is completed, you need to make sure that the synergy will create some value in order for your securities to experience a certain capital appreciation in the foreseeable future. Okay, so you need to focus on what are the potential catalyzers once you acquire this kind of securities at a discount. Okay. Now, the case of the bankruptcy, well, you are not, of course, interested in buying shares of a company that is getting into bankruptcy. Okay, that would be crazy. You will lose your money. But there are particular situations in which the management agree or make an agreement with the suppliers or with the banks or with the bondholders to emerge with more capital inflows, and of course make a turnaround of the company. So under that situation, you need to study carefully what are the prospects of this company. It is likely that the company that that was making this agreement is paying with the new shares the payments of the part of the payments for the suppliers, part of the payments for the bondholders, part of the payments for the banks, and so on. All of these debtors will start a sell-off of all these new shares, but in order for you to acquire these shares at a discount, it is important to make sure that if they will experience a capital appreciation for the next 1 year, for the next 2 years. And the only way to do that is to know what is the compensation of the management, what is the growth prospects of the company, what is the tailwinds of the industry. Where of course you need to make sure that you are not buying quality here, because there's a reason why these kind of companies are getting into bankruptcy here. But of course there are situations in which there are companies that got into bankruptcy because they had so much debt, and that was because probably they were over optimistic about their growth prospects. Probably if they wouldn't ask so much debt, they would be better with a stronger market position in their respective industry. Probably we need to focus in this kind of particular situations in order to take advantage of this kind of bankruptcy situations. And in the case of the corporate restructuring, well, the corporate restructuring is more associated with a holding company that is divesting most of its underperforming assets, underperforming subsidiaries, in order to, once they sell all these assets, they will receive all that money from the sale, and then they will reinvest in its core business. Okay, or pay more dividends to the shareholders. That's a kind of situation in which you can buy these kind of companies before the corporate restructuring is announced. Look at the case of has taken advantage of these kind of situations. Investor Buffett acquired 50% of General Dynamics here. So this is from the year 1992, and you can realize that in this case General Dynamics was divesting several of its subsidiaries and assets, most of them underperforming, and that with all that money received from the sales, they were reinvesting in its core business, those business in which they will earning a higher net margins, a higher cash flow, and that's how the shares of Warren Buffett has experienced an important capital appreciation after his acquisition of the General Dynamics. Here we need to make sure that we need to be really selective. We need to have certain experience, of course, in dealing with these kind of situations here. There is a special situation in the activism. You know that the activist investors are those investors who take or who buy an important amount of shares, an important participation of a public company in order to influence in the board, in order to fire the CEO, in order to propose changes that really create more value. This is the case of, for example, of Carl Icahn, which is a famous investor to do this kind of activities, to this kind of activism within different companies, creating so much value for the shareholders. Of course, he was influenced by the Ben Graham's strategy, because in order to do this kind of strategies, you need to make a calculation. What is the worth of a certain company, and then we need to propose changes in order to increase the valuation of this company. So here there are different situations in which the value investing could be more complex, but of course there is many opportunities in order to calculate the intrinsic value under specific situations and see if the price that you are paying is really below the intrinsic value that you are calculating here. So the book that it could be recommended for this kind of a strategy is the You Can Be a Stock Market Genius from Joel Greenblatt. It is rather advanced book, but of course I'm sure that you will learn so much interesting to read this book about all the cases that he had to face when he was managing the Gotham fund, and he of course has earned something like 40% of profitability year by year for several years. And something that would be interesting to know here is that you can explore several ideas about the Value Investors Club.com. You can get into this website and you can find so many ideas that could be really interesting to know. So really, as you may notice here, there are different strategies within the value investing philosophy. But of course, we need to be clear about what is the main difference between investing and speculating, because in the end, when we are investing, we are preserving our capital and getting an adequate return for our capital for investing. But in the case of the speculation, there is a higher risk to experience a permanent loss of capital, and that is something that most people do not understand. So whenever we are trying to use any sort of strategies totally outside the value investing philosophy, we are speculating. For example, when we are focused on the growth stocks, well, most people who are more committed to the growth stocks, they do not make a differentiation between growth quality and growth of speculative stocks. So for them, they are putting companies like Microsoft, companies like Facebook, companies like Alphabet or Apple in the same league as other companies like Roku, companies like Square, different companies who never had a profitability. So they are trading at a higher multiples because because of the expectations that the investors have respect to the promising future of these companies. So in our view, as a value investors, of course, we are not investing in those kind of companies that never have demonstrated to be profitable, but investors are expecting that these companies will be profitable at some point in the future. Those are speculation because you are expecting in something that never happened. Okay, it could happen, but of course, we as an investor prefer to stay away from those bets. Another way to be a speculator is when you are just more focused on the short term, just focusing the chart, focusing the momentum, focusing the support, focusing the scalping, focusing Fibonacci on weird terms and weird concepts that of course they are not related with the business behind all those charts, because we need to be more focused in the business behind the charts, behind the stock market price, because in the end the only driver, the most important driver in the long term that truly influencing the price in the long term price is the business model of the companies. And of course, we need to take into account that in the end, when we are making so much trading, we need to pay, and I mean, unless we have a tax-free account, we will need to pay taxes for capital gains. Those are the taxes that really destroy our long-term profitability. Most of the traders do not think so much about how many trades they are doing during the entire year, because they are really focused on the week, they are focused on the day, so they forget that how many trades they are doing during the year, and they have to pay taxes for all these capital gains. And in the long term, I mean, with a perspective of 5 or even 10 years, they have paid so much money in taxes for those capital gains, and that of course destroyed their long-term profitability, but they are totally unaware of that. But something that I will give you right now is an example, a really easy example to understand in order to compare the buy and hold strategy with the trading strategy over the long term. So I will start right now. So this is the both strategies. In order to compare, we will make a simple exercise in order to find out which of those strategies, the buy and hold, which is one of the strategies of the value investing strategy here, and the trading, in order to see which of them is the most profitable in the long term. So in order to do that, we will assume that we found a stock that could double each year. This stock is trading at a $1 per share right now. So imagine that you are a value investor, and you will apply the buy and hold strategy here, and you will buy this stock for $1. So once you buy this stock, you will hold this stock for all the years. So you will see that in each year the stock will double in each year. So in the year 21, you will have in your account more than $1 million in your account. Okay, so here we will compare it with the trading strategy here. So the trader will find the same amazing stock that could double each year by year. So here he will be able to buy this stock at a $1 at the beginning of the year one, and of course he will sell that stock at the end of the year one. So in order to determine what is the profits of his trading here, we will calculate these profits just taking the revenues, because the stock will be 2, okay, in the end of the year one, and then we will need to subtract his cost, which was 1. Okay, now we need to take into account here, this is the most important part here, the taxes, because he will need to pay the taxes for capital gains here in each year. So here we will need to replicate here what is the his profits here, and then we will find that he will earn something like 0.66 in this trade. So at the beginning of the year 2, he will find that he will have $1.7 in his account. Look at this. He will think, okay, I have invested $1 in the first year, and now in the second year I have 1.7. That's amazing. I will keep investing in this amazing stock. So given the fact that in the year 2 is just $2 per share, and he only have only $1.7 per share, he will ask for a loan with a 0 interest rate. We will assume a 0 interest rate in order to not simplify this simple scenario. So here he will use this $1.7 per share to buy again this stock at the beginning of the year 2, and then sell his stock at the end of the year 2. So in order to find what is his profits here, we will need to take the revenues and subtract the cost here, and we will need to take into account now the taxes that he will need to pay here. Okay. And this is the profit again here, and then we will have 1.10 here. So at the beginning of the year 2, or at the end of the year 2, or at the beginning of the year 3, he will find this that in his account there is $2.8 per share here. So he will continuously repeating in each year. He will buy at the beginning of each year, and he will sell at the end of each year, and he will make a profitable trades during for the next 20 years. Look at this, how at the end of the year 21, he will see in his account, that's amazing for him. According to him, he was making a profitable trades during all these 20 years. But look at this, the final result of his trading, of his strategy, just $25,244 in his account. While these are our value investor who was using the buy and hold strategy has more than $1 million in his account here. And you probably are asking yourself why that is happening. Because, well, given the fact that this trader is paying taxes each year, and all these taxes could have been compounded over the years, but instead of that, he is paying all that money that could have been compounding, he is paying all that money to the government here. So that's why it's a terrible strategy for the long term, and most traders probably didn't realize how much inefficient this strategy is to make these kind of traders, just because of this cost. And we are not assuming other costs, because there are other costs associated with the cost with respect to the broker, the cost with respect to the financial leverage, in case there are traders who likes really the financial leverage in order to increase their profitability. Well, there are different costs that we are not considering, and we are just considering just one cost. And look at this, how bad the final result is in this kind of a strategy. So as you have seen, there are several strategies within the value investing philosophy, and of course you can explore any of them in order to increase your background in investment, and of course to increase the opportunity to make more profitable investment, taking advantage of this value investing philosophy here. So if you really have enjoyed this video, please put a like, it is for free, and consider to subscribe to in this channel, because I will continuously delivering more and more information about different companies, about the valuation of different companies, about new concepts that probably most concepts that are not mentioned in many other YouTube channels, and I will explain to you with detail all these new concepts within the value investing philosophy here. So I hope to see you in the next video. Peace.